Before we begin, a quick but important note. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. I am not a licensed insurance agent or financial advisor. You should always consult with a qualified professional before making any decisions regarding your insurance coverage. Imagine two neighbors, Sarah and Mike. They live on the same quiet suburban street. They both drive a 2022 Honda CR-V. The exact same trim level, same color. They bought them in the same month. Both Sarah and Mike have been driving for 15 years and have never had a single accident or a speeding ticket. Not one. On paper, they are identical risks. Yet, every 6 months when the bill arrives, Mike pays $450 more for his car insurance than Sarah does. That's $900 a year. Over a decade, that's $9,000, enough for a down payment on a new car, vanished into thin air for what seems like no reason at all. Why? What is the hidden variable that makes Mike a more expensive driver than Sarah in the eyes of an insurance company? The answer isn't a secret. It's a formula. A complex, data-driven algorithm that assesses every tiny detail of your life to predict one single thing. How likely are you to cost them money? For most of us, car insurance is just a bill we have to pay. It's this mysterious, non-negotiable expense that arrives like clockwork. We shop around a little, pick the cheapest quote, and hope for the best, never truly understanding why the number is what it is. We feel powerless, like we're just a number in a spreadsheet, at the mercy of a system we can't see or comprehend. This video is going to change that. Forever. We are not just scratching the surface here. We're not going to give you a fluffy list of 5 tips to save on insurance. You've seen those videos. They're useless. Today we are prying open the black box. We are going to expose the entire formula piece by piece so that you can finally understand the game you're forced to play. And once you understand the rules, you can start winning. You can take control. You can become Sarah, not Mike. By the end of this presentation, you will know more about how car insurance is priced than 99% of the population. You will understand why your neighbor with the sports car might pay less than you do in your minivan. You will learn about the factors you absolutely cannot change, the ones you can influence over time, and the secret levers you can pull right now to potentially slash your premium. This is the masterclass on car insurance pricing in the United States that the insurance companies hope you never see. So let's start with the absolute foundation. The one concept that governs every single decision an insurance company makes. It's not about fairness. It's not about rewarding good drivers. It's about one thing and one thing only: risk. An insurance company is, at its core, a massive multi-billion-dollar gambling operation. And you are the subject of their bet. When you pay your premium, you are placing a bet with them. You're betting that you will get into an accident, and they're betting that you won't. Your premium is the price of that bet. If you get into a major accident, you win the bet, and they have to pay out tens or even hundreds of thousands of dollars. If you drive safely for years, they win the bet, and they get to keep all your money. Their entire business model depends on being better at predicting the future than you are. They need to collect more in premiums from the winners, the safe drivers, than they pay out in claims to the losers, the drivers who crash. To do this, they have built one of the most sophisticated risk assessment machines in human history. They employ armies of actuaries, statisticians, and data scientists whose only job is to calculate the precise probability that you specifically will file a claim. Every piece of data they collect about you is fed into this machine. It's all just another input in the grand equation of risk. They aren't judging you as a person. They are calculating you as a statistic. You are a collection of risk factors, and each factor either adds a few dollars to your premium or subtracts a few. So what are these factors? Let's start with the most obvious category, the one everyone thinks of first. You, the driver. The first thing they look at is, of course, your driving record. This is the big one. Your motor vehicle report, or MVR, is your driving resume. Have you had any at-fault accidents in the last 3 to 5 years? Each one is a massive red flag. It's direct historical evidence that you have, in fact, cost an insurance company money in the past. To them, that's the single best predictor that you'll do it again. A recent at-fault accident can spike your rates by 40% or more, and that surcharge can stick around for years. Then there are moving violations. Speeding tickets, running a red light, improper lane changes. These might not have caused an accident, but they demonstrate risky behavior. A single speeding ticket might only bump your rate by 10 or 20%, but get 2 or 3 in a short period. Now you're telling the algorithm that you're a habitual risk taker, and your premium will skyrocket. And God forbid you get a DUI or a reckless driving charge. That's the cardinal sin. It's the equivalent of telling the casino you're going to count cards. Your rates will double, triple, or your insurer might just drop you altogether, forcing you into a high-risk pool with astronomical costs. But your record is just the beginning. The next factor is your age. This is where it starts to feel a little unfair. Statistically, the most dangerous drivers on the road are the youngest ones. Teenagers, specifically males under the age of 25, have the highest crash rates of any demographic. It's not personal. It's just cold, hard data. They lack experience, they're more prone to distraction, and they're more likely to engage in risky behaviors like speeding or driving under the influence. As a result, a 17-year-old male will pay a fortune for insurance, often 3 or 4 times what their 40-year-old parent pays for the exact same coverage on the exact same car. On the flip side, as you age, your rates steadily decline. You hit the sweet spot for insurance rates from your late 40s to your early 60s. You're seen as experienced, mature, and responsible. But then, something interesting happens. As you get into your late 60s and 70s, the rates start to creep back up again. Why? Again, statistics. Older drivers, as a group, have a higher rate of accidents per mile driven, often due to slower reaction times or deteriorating vision. It feels like age discrimination, and in a way it is, but to the insurance company, it's just statistical risk modeling. Hand in hand with age is driving experience. How long have you been a licensed driver in the United States? Someone who just got their license at age 30 will pay more than a 30-year-old who has been licensed since they were 16. Experience, in the eyes of the algorithm, equals predictability. The more years of clean driving you have under your belt, the more confident they are that you're a safe bet. This is just the first layer. We've only talked about you as a driver. We haven't even gotten to the car you drive, where you park it at night, your marital status, your credit score, or even your level of education. Yes, all of those things can have a dramatic impact on that bill you pay every 6 months. And we are going to break down every single one. Because Mike deserves to know why he's paying $9,000 more than Sarah. And you deserve to know how to stop being Mike. Let's start with the factor you have the least control over, but one that has the most control over your wallet: your age. Insurance is a game of statistics, and the coldest, hardest statistic in the industry is this: young drivers are a massive risk. A 16-year-old getting their license for the first time is, statistically speaking, an accident waiting to happen. The CDC tells us that the crash rate per mile driven for 16 to 19-year-olds is almost 3 times the rate for drivers aged 20 and over. Think about it from the insurer's perspective. They have no data on this new driver. No history, no track record. All they have is a mountain of data on millions of other teenagers who have come before them, and that data paints a terrifyingly expensive picture. It's not personal. It's purely actuarial. The part of the human brain responsible for rational decision-making and impulse control, the prefrontal cortex, isn't fully developed until around age 25. Insurers know this. They know that a younger driver is more likely to speed, more likely to be distracted, and less likely to react safely to a sudden hazard. This is why Mike, our 18-year-old with the souped-up Civic, is starting in a financial hole so deep he can barely see the light. He's paying what's often called the teen tax. His premium is astronomically high because the probability of him costing the insurance company money is also astronomically high. But here's the good news. This gets better. And it gets better on a predictable schedule. The single biggest birthday you will have for your car insurance rate is your 25th. That's the magic number when insurers see you officially graduate from the highest risk category. Your rates will see a significant drop, assuming you've kept a clean record. From there, the discounts continue to trickle in. Rates generally continue to decrease and then level out through your 30s, 40s, and 50s. This is the insurance sweet spot. This is where Sarah, our 45-year-old minivan driver, lives. She has decades of proven safe driving experience. To an insurer, she is the gold standard, a known quantity, a predictable and low risk. Her age is giving her a massive built-in discount that Mike can only dream of. But the story doesn't end there. As drivers enter their late 60s and 70s, rates can begin to creep back up again. Vision may decline, reaction times can slow, and the data shows a slight uptick in accident frequency for elderly drivers. It's usually not as dramatic as the teen penalty, but it is a factor. Okay, so age is a huge piece of the puzzle. But let's talk about a more controversial one: your gender. For decades, a simple rule applied. Young men paid more than young women. Period. The reasoning was, again, purely statistical. Historically, data showed that young male drivers were involved in more accidents, more severe accidents, and more fatal accidents than their female counterparts. They were more likely to engage in risky behaviors like speeding, aggressive driving, and not wearing a seatbelt. So, our friend Mike wasn't just getting hit with a teen tax, he was getting hit with a young male tax on top of it. However, the world is changing. The use of gender as a rating factor has become a major point of contention. Many argue it's discriminatory. As a result, several states have banned the practice entirely. If you live in California, Hawaii, Massachusetts, Michigan, Montana, North Carolina, or Pennsylvania, your insurer is legally not allowed to use your gender to calculate your rate. In these states, a male and female with an identical profile will be quoted the same price. In other states, the practice continues, but the gap has been narrowing. As driving habits become more similar across genders, the statistical differences are shrinking. And it's important to note, this gender gap almost always disappears with age. By the time drivers are in their 30s, the difference in rates between men and women becomes negligible or non-existent. Now for a factor that makes people scratch their heads, your marital status. Why on earth would an insurance company care if you're married, single, or divorced? Seems incredibly personal. But once again, it all comes back to the cold, hard data. Decades of claims information shows a clear trend. Married people get into fewer accidents and file fewer claims than single people. So why does getting married suddenly make you a better driver in the eyes of an insurer? The theory isn't that the wedding ring itself has magical protective powers. It's that getting married is seen as a life milestone that signals stability and responsibility. Insurers assume that a married person is likely to be more cautious. They might have a spouse and maybe even children in the car. They have more to lose. They're less likely to be out late at night, less likely to engage in risky driving behaviors. A married individual is, in the statistical universe of insurance, a more settled, predictable, and therefore less risky client. So Sarah, our 45-year-old minivan driver, is not just getting a discount for her age. She's married. That's another checkmark in the low-risk column, shaving even more off her premium. Mike, our 18-year-old, is single. It's another small but significant factor stacking up against him, contributing to that $9,000 gap between them. But now we arrive at the silent assassin of your premium, the one factor that can make two identical people, with identical cars and identical driving records, pay wildly different rates. We're talking about your address. And not just your state, not just your city. We're talking about your specific 9-digit zip code. Location is one of the most powerful rating factors in existence. You could move just 5 miles down the road to a different zip code and see your insurance premium swing by hundreds, or even thousands of dollars a year. It feels arbitrary, but from the insurer's perspective, it's hyperlogical. They are insuring your car in the environment where it lives and operates. First, they look at population density and traffic patterns. A driver living in a dense urban center like Brooklyn, New York, is surrounded by millions of other cars, aggressive taxis, and unpredictable pedestrians every single day. The chances of a fender bender, a sideswipe, or a parking lot ding are incredibly high. Compare that to someone living in rural Wyoming who might drive for miles without seeing another car. The risk of a collision is fundamentally lower. More cars simply equals more opportunities for accidents. Next, they analyze crime statistics for your specific zip code. They know exactly how many cars are stolen, broken into, or vandalized in your neighborhood each year. If you live in an area with a high rate of auto theft, the cost of your comprehensive coverage, the part that pays for theft, is going to be higher. It has nothing to do with you personally. You could have a locked garage and a state-of-the-art alarm system. But if the risk in your general area is elevated, your rate will reflect that. Then there's the weather. A policy written in Miami has to account for the significant risk of hurricane damage. A policy in Oklahoma has to factor in the high probability of hail, which can cause thousands of dollars in cosmetic damage to hundreds of cars in a single storm. A driver in Buffalo, New York, pays more because of the constant risk of accidents on icy, snow-covered roads for a large portion of the year. Each region has its own unique, built-in environmental risks, and your premium is tailored to them. Finally, and this is a big one, is the local legal environment. Some states are no-fault states, which can affect how claims are paid out. More importantly, some areas are just more litigious than others. In certain jurisdictions, it's much more common for accidents to result in expensive lawsuits. Insurers have to price in this risk. If they know that a simple rear-end collision in your county is more likely to end up in a prolonged and costly legal battle, they have to charge everyone in that county a little bit more to cover those potential future legal fees. So Sarah doesn't just benefit from her age and marital status. She lives in a quiet suburban zip code with low crime, fewer cars, and a less lawsuit-happy culture. Mike might live just 20 miles away, but in a dense urban center with higher theft rates and congested streets. That difference in location alone could account for a massive portion of their premium disparity. It proves that when it comes to car insurance, your neighbor's driving habits can affect your wallet almost as much as your own. You are, quite literally, paying for the risks of everyone around you. We've now peeled back the first major layer of the onion, the driver themselves. Your age, your personal details, and where you park your car at night create the fundamental baseline for your rate. But we haven't even talked about the second most important character in this story yet. The one you choose, the one you drive every single day. Your car. And how an insurer views your choice of vehicle, from a humble sedan to a roaring sports car, is far more complex and surprising than you could ever imagine. Let's pull back the curtain on the insurance company's command center. Imagine a vast humming server room where an algorithm, a complex digital brain, is tasked with one thing: predicting the future. Your car is the subject of its intense scrutiny. It's not judging your taste, it's calculating risk. And it starts by asking 3 fundamental questions about your vehicle. Question 1. If this car gets into a crash, what's it going to cost us to fix it? Question 2. How likely is this specific car to get into a crash in the first place or get stolen? And question 3. When it does crash, how much damage is it likely to cause to other people and property? Every single car on the road has a detailed, data-rich answer to these questions, and the answers are what drive your premium up or down. Let's start with the first question, the cost to repair. This seems simple, right? A more expensive car costs more to fix. A $20,000 Honda Civic is cheaper to repair than a $90,000 Porsche. That's true, but it is a dangerously oversimplified version of the truth. The real story is in the details. The algorithm isn't looking at the sticker price you paid. It's looking at the price of a new front bumper, the cost of a replacement headlight, the hourly rate for a mechanic certified to work on that specific make. Consider 2 brand new sedans, both costing around $30,000. One is a basic, no-frills model. The other is the top-tier trim, loaded with advanced driver assistance systems. It has adaptive cruise control, lane keeping assist, and automatic emergency braking. You bought it thinking, this is safer. This will lower my insurance. But this is where we encounter the great paradox of modern car insurance. Those safety features rely on an intricate network of cameras and sensors, many of which are embedded directly into your windshield and your bumpers. So you get a small crack in your windshield from a rock on the highway. On the basic car, that's a few $100. Annoying but manageable. On the high-tech car, replacing that same piece of glass can cost over $1,000, even $2,000. Why? Because the camera mounted to it has to be professionally recalibrated with specialized equipment. A minor fender bender that used to mean a simple bumper replacement now involves replacing multiple sensitive radar sensors, each costing hundreds of dollars, plus the labor to ensure they all work perfectly. The very technology designed to prevent accidents is making the cost of even minor repairs skyrocket. The insurance company's algorithm knows this. It has access to a massive database of millions of repair claims. It knows down to the dollar that the car with the fancy tech, while maybe slightly less likely to crash, is exponentially more expensive to fix when it does. And so, your premium for the safer car might actually be higher. It's not just tech. It's the materials. For decades, most cars were made of steel. It's cheap, it's strong. It's easy for any body shop to work with. But today, to meet fuel efficiency standards, manufacturers use exotic, lightweight materials. That aluminum body on your new pickup truck? It saves gas, but it's much harder and more expensive to repair than steel. It requires specialized training and tools. Carbon fiber components on a sports car? They're incredibly strong and light, but you don't repair them. You replace them at an astronomical cost. The algorithm sees your car not as a single object, but as a collection of thousands of parts, each with a price tag and a replacement cost attached. Now for the second question. How likely is this car to have a claim filed against it? This is where the car's personality comes into play. Insurers look at reams of historical data for your exact year, make, and model. They call this loss history, and it tells a story. Let's compare a Toyota Sienna minivan to a Ford Mustang GT. The data is overwhelming. Minivans are typically driven by parents, often with children in the back. They're used for school runs and grocery trips. They are, statistically, some of the most cautiously driven vehicles on the road. The Ford Mustang GT, on the other hand, is a symbol of American muscle. It has over 450 horsepower. It's not designed for hauling groceries. It's designed for performance. Insurance companies know that a person who buys a car with that much power is, on average, more likely to use that power, more likely to accelerate quickly, more likely to drive aggressively, and therefore statistically more likely to get into an accident. It's not a personal judgment on you. It's a cold, hard calculation based on the behavior of hundreds of thousands of other drivers who own that exact same car. The car itself creates a sort of moral hazard. Its capabilities tempt a certain style of driving, and the claims data proves it. But it's not just about crashes. It's about theft. The algorithm knows which cars are magnets for thieves. And again, the answer is often surprising. It's not always the six-figure luxury cars. In fact, for many years, the most stolen vehicles in America were humble family sedans like the Honda Accord and Honda Civic. Why? Because there are millions of them on the road, creating a massive black market for their parts. More recently, you've seen the headlines about certain Kia and Hyundai models. A design flaw made them incredibly easy to steal, leading to a nationwide spike in thefts. Insurance companies saw this happening in real time. Their data lit up like a Christmas tree. Claims poured in. And so, in a matter of months, the risk profile for those cars completely changed, and premiums for their owners shot through the roof, with some insurers even refusing to cover them at all. Your car's vulnerability is a direct factor in your rate. Finally, the algorithm asks the third question. How much damage can this car do? This is all about liability. If you're at fault in an accident, your insurance pays for the damage you cause to others. So, the insurer has to predict the potential for destruction your vehicle possesses. Imagine a collision between a 2,000-pound smart car and a 9,000-pound Ford F-450 Super Duty pickup truck. The laws of physics are not kind. The sheer size and weight of the truck mean it is capable of inflicting vastly more damage to another vehicle and its occupants than the smart car is. A heavier, larger vehicle represents a greater liability risk, and the premium will reflect that. It's not just about protecting your car. It's about protecting the company from the damage your car is capable of causing. So, how does an underwriter, a human being, possibly keep all of this straight for every car on the market? They don't have to. The industry has a cheat sheet. It's a system managed by the Insurance Services Office, or ISO. They take all of this data, repair costs, theft rates, safety records, damage potential, and distill it down into a simple code, a vehicle series rating. Think of it as your car's secret report card. It's a number that every insurance company can use as a starting point. A low number, like on a Subaru Outback, indicates a low risk. A high number, like on a Maserati, signals a high risk and a high premium. Your choice of vehicle sets the entire stage for your insurance costs. It's a complex character in this financial drama, with a backstory written in millions of data points on repair costs, accident statistics, and theft reports. You might see a car, but your insurer sees a risk profile, a prediction of future costs, a single number on a secret report card that defines its potential for financial pain. You've now picked the perfect car, one with a reasonable risk profile. You've done your homework. But the moment you drive it off the lot, another factor, one that's completely out of the car's control, takes over. A factor so powerful it can make the insurance on a cheap car in one place more expensive than the insurance on a luxury car just a few miles away. We're talking about where you live. The story of your insurance rate is literally written on a map, and where your car sleeps at night changes everything. Your zip code is more than just a number for the mailman. It's a risk profile. It's a shorthand that tells an insurance company a story about your daily environment. And that story begins at the highest level, the state you live in. Think of the United States not as one country, but as 50 different insurance marketplaces, each with its own set of rules, its own culture of driving, and its own unique risks. This is why a driver in Michigan can pay, on average, 3 or even 4 times more for the exact same coverage as a driver in Maine. It's not because people in Michigan are inherently worse drivers. It's because of state laws. Michigan, for a long time, was a no-fault state with unlimited, lifetime personal injury protection benefits. That means if you were injured in an accident, your own insurance paid for your medical bills no matter who was at fault for the rest of your life. Imagine the cost of that. It created an incredibly expensive system, and that cost was passed directly onto every single driver in the state. On the other hand, a state like Maine has lower population density, fewer major urban centers, and different insurance regulations. leading to some of the lowest rates in the country. States like Louisiana and Florida are expensive for other reasons. They have a high number of lawsuits related to accidents, which drives up legal and settlement costs for insurers. They also grapple with a higher frequency of severe weather events like hurricanes, which we'll get to. Every state sets its own minimum liability coverage limits. Some states require you to carry very little insurance, which might sound good, but it can create a riskier environment for everyone. If the person who hits you only has $10,000 in property damage liability, but they total your $50,000 truck, you can see how problems arise. So the first broadest brushstroke on your insurance map is the state line. But that's just the beginning of the story. Let's zoom in. Within that state, are you living in a bustling, dense metropolis like Chicago, or a quiet, rural town in downstate Illinois? This is the next critical layer. An urban environment is, from an insurer's perspective, a minefield of risk. Think about it. In a big city, you have exponentially more cars on the road. More intersections, more traffic lights, more pedestrians, more cyclists. Every single mile you drive is packed with more potential for an accident. The chances of a fender bender, a sideswipe, or a multi-car pileup are just statistically higher. Parking is another urban nightmare for insurers. In a rural area, you probably park your car in a private driveway or a garage. In the city, you might be parallel parking on a crowded street every single night. This dramatically increases the risk of dings, dents, scratches, and smashed mirrors from other cars trying to squeeze into tight spaces. These are small claims, but they add up. And the frequency of these claims in a specific area tells an insurer that this neighborhood is expensive. And then there's crime. Densely populated areas simply have higher rates of vehicle theft and vandalism. Your car is more likely to be stolen, broken into, or have its catalytic converter sawed off if it's parked on a city street versus a quiet suburban cul-de-sac. Insurance companies have access to vast databases of crime statistics, and they map this data right down to the block. They know which neighborhoods have a rash of break-ins and which ones don't. If your car sleeps in a high-crime area, you are considered a higher risk, and your premium will reflect that. Now let's zoom in even closer, past the state, past the city, to the most powerful number in your insurance profile, your 5-digit zip code. This is where the science of rate-making gets almost unnervingly specific. Two people can live in the same city just a mile apart, but if they have different zip codes, they can see a difference of hundreds of dollars a year on their policy. Why? Because insurers aren't just looking at the city as a whole. They're looking at the claims history of your specific neighborhood. They use your zip code to analyze hyperlocal data. How many accidents are reported within that 5-digit boundary? How many cars are reported stolen? How many claims are filed for vandalism? They are essentially creating a risk score for your immediate community. If you live in a zip code where people file a lot of claims, everyone in that zip code, including you, will pay more. You are, in a sense, paying for the driving habits and the luck of your neighbors. This is also where we see the massive impact of something most people never think about: the percentage of uninsured drivers. In some zip codes, the number of people driving without insurance can be incredibly high. Nationally, it's about 1 in 8 drivers, but in some areas of states like Mississippi, Florida, or New Mexico, it can be closer to 1 in 4. If you live and drive in an area where there's a high chance the person who hits you has no insurance, who pays for your repairs? Who pays for your medical bills? You do, through your own uninsured or underinsured motorist coverage. Because the risk of you having to use this coverage is so much higher in that zip code, the price for that coverage goes up for you. You are literally paying a premium to protect yourself from the other drivers in your immediate vicinity. And finally, your zip code tells a story about the weather. This isn't just about driving in snow or rain. This is about catastrophic weather events. If your zip code is in Hale Alley, which runs through Texas, Oklahoma, and Colorado, insurers know there's a significant risk that a single storm could cause cosmetic or even structural damage to thousands of vehicles at once. They price that risk into your comprehensive coverage. If you live in a coastal zip code in Florida or Louisiana, the risk of flooding and total vehicle loss from a hurricane is a constant threat that inflates your rates. If you're in parts of California, the risk of your car being damaged or destroyed in a wildfire is a measurable, calculated factor. This hyperlocal focus on zip codes is one of the most controversial aspects of insurance pricing. Critics argue that it can function as a modern form of redlining, because historical and systemic factors have often segregated communities by income and race. Using zip code as a primary rating factor can lead to a situation where lower income and minority communities end up paying significantly more for car insurance, even if an individual driver in that community has a perfect record. Insurers defend the practice, stating they are not looking at demographics. They are only looking at data, the cold, hard numbers of claims, theft, and accidents that have occurred in that geographical area. They argue that risk is risk, and it costs more to insure a car in an area where more claims are filed. Regardless of which side of the argument you fall on, the reality is undeniable. The 5 digits of your zip code have a profound and direct impact on the price you pay. So the map of where you live, from the state laws down to the specific claims history of your block, draws a detailed, complex picture of the external risks surrounding your vehicle. It's a story about traffic, crime, weather, and even the behavior of your neighbors. It's a massive piece of the puzzle, but it's only half the equation, because there's another map, one that's even more personal and, in many ways, even more impactful. It's not about where your car lives. It's about who you are. And the very first line drawn on that personal map, the one that can swing your rates by thousands of dollars a year, and is a source of endless debate, is your age. And when it comes to age, car insurance companies aren't just looking at the number of candles on your birthday cake. They're looking at a vast, sprawling database of human behavior, a multi-decade story of risk written in twisted metal and police reports. This story has a clear protagonist, or perhaps an antagonist, depending on your perspective: the 16-year-old male driver. To an insurance company, this individual represents the absolute apex predator of risk. He is, statistically speaking, the most dangerous, most unpredictable, and therefore the most expensive person to insure in the entire United States. Putting a newly licensed teenage boy on a policy can cause the premium to double, triple, or in some cases even quadruple. It's a cost so staggering that it feels punitive, like a punishment for simply being young. But it's not a punishment. It's a calculation, a cold, hard assessment based on a brutal trifecta of risk factors. The first factor is the most obvious: inexperience. Think about it. We don't let a medical student perform open-heart surgery on their first day. We don't let a law student argue a Supreme Court case after one mock trial. Yet, we put a 16-year-old, after just a few dozen hours of supervised practice, in command of a 2-ton steel machine capable of traveling at lethal speeds. The complex dance of defensive driving, monitoring multiple threats, predicting the irrational behavior of others, judging stopping distances in the rain, managing a skid on ice. These are not innate skills. They are learned, often through terrifyingly close calls and minor mistakes. For a new driver, every merge onto a highway is a final exam. Every 4-way stop a complex negotiation. The insurance company knows this. They have seen the data on fender benders in parking lots, on misjudged left turns, on overcorrecting a swerve. This initial period is a minefield of small, costly errors, and the premium is the price of admission to that learning curve. But inexperience is only part of the story. If it were the only factor, a 40-year-old who just got their license would be just as expensive as a teenager. They're not. Not even close. And that brings us to the second, more fascinating factor: neuroscience. The human brain, specifically the prefrontal cortex, is not fully developed at age 16. It's still under construction, and it won't be finished until around age 25. And what exactly does the prefrontal cortex do? Oh, just a few minor things like managing impulse control, assessing long-term consequences, and regulating emotions. It's the brain CEO, the voice of reason, that says, maybe showing off by taking that corner at 50 miles per hour is a bad idea. Or, maybe you should put the phone down and focus on the road. Or getting into a race on the freeway could have catastrophic consequences. In a teenager, that CEO is often on vacation. The brain is being run by the amygdala, the more primitive emotional center that's great for gut reactions but terrible at nuanced risk assessment. This isn't a character flaw. It's a biological reality. It's why teenagers are more susceptible to peer pressure, like friends in the car goading them to drive faster. It's why they are more likely to engage in thrill-seeking behaviors behind the wheel. The insurance company isn't judging their character. They are pricing the biological reality of an underdeveloped prefrontal cortex. They know that a young driver is neurologically hardwired to make poorer decisions in high-stakes situations. The third and final factor is the one that ties it all together: the undeniable tragic data. According to the CDC, the crash rate per mile driven for 16 to 19-year-olds is nearly 3 times the rate for drivers aged 20 and over. Motor vehicle crashes are the second leading cause of death for U.S. teens. And when you look inside those numbers, another pattern emerges which explains the gender gap. Young men are historically more likely than young women to be involved in fatal crashes due to a higher statistical likelihood of speeding, driving under the influence, and not using a seatbelt. It feels unfair to penalize an entire demographic for the actions of the riskiest among them, but insurance is a game of statistics, not individuals. The company isn't insuring your son, the straight-A student who is cautious and responsible. They are insuring a statistical cohort, and the data for that cohort is terrifyingly clear. So, the teenage years are a trial by fire. But then, something magical happens. A birthday comes and goes, and suddenly the insurance bill drops. Then it happens again and again. The journey of aging in the eyes of an insurer is a journey toward predictability and safety. The first major milestone is the 25th birthday. This is the age that is whispered about in online forums, the light at the end of the tunnel for young drivers. Why 25? Because it's the convergence point. By now, that prefrontal cortex is fully online. The CEO is back in the office. Impulse control is stronger and risk assessment is sharper. Simultaneously, the driver has hopefully accumulated nearly a decade of driving experience. They've navigated countless hazards, learned from their close calls, and settled into a more predictable routine. The statistical risk plummets, and the premium follows suit. From age 25 to around age 65 is what you could call the golden age of insurance rates. This is the sweet spot. Drivers in this bracket are at their peak. They have maximum experience combined with peak physical and cognitive abilities. They are often commuting to work, running errands, driving in predictable patterns. They are, as a group, the safest and most profitable clients for an insurance company. Their rates are stable, and assuming they keep their record clean, they will enjoy the lowest premiums of their lives during these decades. But the story of age is not a straight line. It's a U-shaped curve. Just as rates fall dramatically in your 20s, they begin to slowly, almost imperceptibly, creep back up as you enter your late 60s and 70s. This is often a difficult and frustrating reality for senior drivers who may have a lifetime of accident-free driving behind them. Why would their rates go up? Once again, it comes back to the cold, hard data. As we age, physical faculties can begin to decline. Vision might not be as sharp, especially at night. Hearing can be diminished, making it harder to notice an approaching emergency vehicle. Most importantly, reaction time slows down. The split-second decision-making required to avoid a collision can become just a fraction of a second slower. And in a car, a fraction of a second is an eternity. The data shows a clear uptick in crash rates and fatalities for drivers over the age of 70. The risk, which had been dormant for 40 years, begins to rise again. So age acts as a powerful, if blunt, proxy. It's a stand-in for experience, brain development, and physical ability. It tells the insurance company a story about the kind of driver you are likely to be based on millions of others who have come before you. It's a powerful chapter in your insurance calculation, painting a broad picture of your potential risk. But it's only a prediction. It's the story of who you might be. The next factor we're going to look at is far more personal. It's not about your potential. It's about your past. It's the story of the driver you have actually been. We're talking about your driving record. If demographic data is the prediction, your driving record is the proof. It's the single most powerful and direct piece of evidence an insurer has to determine what kind of driver you are. Think of it this way: when you apply for car insurance, you're essentially applying for a job. The job is low-risk client. The insurance company is the hiring manager, and your driving record is your resume. Everything else we've talked about, your age, your location, your gender, that's like the background information on your application. But your driving record? That's your work experience. It shows what you've actually done out there on the road. And just like a resume, some things on it are minor typos while others are career-ending disasters. Let's start with the biggest, boldest, most consequential item on this resume: at-fault accidents. An at-fault accident on your driving record is the equivalent of telling a potential employer that you were fired from your last 3 jobs for burning down the office. It is the most significant negative event that can impact your rates, period. When an insurer sees an at-fault accident, they don't just see a mistake. They see a proven liability. They see a driver who has already cost an insurance company, perhaps their own, perhaps another's, a significant amount of money. Their internal calculus is simple. You've done it before, so the statistical probability of you doing it again is now dramatically higher than it is for someone with a clean record. The financial penalty for this is called a surcharge, and it can be brutal. A single at-fault accident can jack up your premium by 30, 40, even 50% or more, depending on the severity and the state you live in. This surcharge isn't a one-time thing. It typically stays on your policy for 3 to 5 years. Do the math on that. A 40% increase on a $1,500 annual premium is an extra $600 per year. Over 3 years, that's an $1,800 mistake. Over 5 years, it's a $3,000 mistake. And that's on top of your deductible and the sheer trauma of the accident itself. The key phrase here is at fault. If you're rear-ended at a stoplight, that's typically a not-at-fault accident. While it might still be noted on your claims history, we'll get to that. It doesn't carry the same catastrophic weight as an accident where you were the one deemed responsible. Now, let's move down the resume to the next section, your skills and certifications, or in this case, your traffic violations. These are the speeding tickets, the illegal lane changes, and the stop sign violations. Unlike an accident, a single ticket isn't usually a deal breaker, but it tells a story. It's like a typo on your resume. One might be overlooked as a simple mistake. 2 or 3 start to form a pattern of carelessness. The insurer sees them as leading indicators, behaviors that make a future accident more likely. But not all tickets are created equal. They exist on a spectrum. On the low end, you have minor infractions. A ticket for going 9 miles per hour over the speed limit or a non-moving violation like a broken taillight might barely move the needle, or not at all. Insurers call these minor violations. They're the typos. Then you have major violations. This is where the real damage happens. We're talking about things like driving 25 or 30 miles per hour over the speed limit, reckless driving, or street racing. These aren't just typos anymore. This is like lying about your qualifications on your resume. It demonstrates a fundamental lack of judgment and a willful disregard for safety. A major violation can have an impact on your rates that's very similar to an at-fault accident, easily increasing them by 20 to 40%. And then there's the ultimate resume killer. The one thing that gets your application thrown into the shredder. A DUI or a DWI. A conviction for driving under the influence is not a red flag. It's a bonfire. To an insurance company, it is the single most irresponsible act a driver can commit. It signals a catastrophic failure of judgment that puts you in the absolute highest risk category. The consequences are severe and multifaceted. First, your current insurer will likely drop you at your next renewal. You become too toxic to insure. This forces you into what's called the non-standard or high-risk market, where premiums are astronomically higher. Second, you'll almost certainly be required by your state to file something called In-State Route 22. In-State Route 22 is not a type of insurance. It's a certificate of financial responsibility that your new, high-risk insurance company files with the state to prove you have coverage. It's basically a guarantee to the DMV that you're insured. It's the insurance equivalent of an ankle monitor. You are now a ward of the state, and your insurer is your probation officer. A DUI can haunt your insurance rates for 5, 7, even 10 years, costing you tens of thousands of dollars over its lifetime. Now for a crucial distinction that trips a lot of people up: the difference between your driving record and your claims history. Your driving record is maintained by your state's Department of Motor Vehicles. It tracks violations and convictions. Your claims history, on the other hand, is tracked by private databases accessible to insurers, like the Comprehensive Loss Underwriting Exchange, or CLUE report. This report lists every claim you filed with any insurer for the past 7 years. This is where things get interesting. Let's say your car gets pummeled by hail while it's parked. You file a comprehensive claim. It wasn't your fault. You weren't even in the car. It's an act of God. It won't appear on your DMV driving record as a violation, but it absolutely will appear on your CLUE report as a claim. And while a single comprehensive claim might not raise your rates, a pattern of them can. If you filed 3 comprehensive claims in 3 years, 1 for hail, 1 for a cracked windshield, and 1 because your car was stolen, the insurer starts to see a pattern. It might not be your fault, but you start to look like a magnet for bad luck. And in the world of insurance, bad luck is just another word for risk. They might not surcharge you for these claims, but they may decide not to renew your policy, seeing you as a client who is simply more trouble than you're worth. So, how long does this information haunt you? How long does a bad entry stay on your risk resume? For most minor violations and at-fault accidents, the look-back period is typically 3 to 5 years. After that time, they fall off your record for insurance rating purposes, and your rates will come back down, assuming you've kept your record clean in the meantime. It's the insurance world statute of limitations. This is why safe driving is a long-term financial strategy. Every day you drive without an incident you are one day closer to a cleaner record and a lower premium. For major events like a DUI, as we discussed, that shadow is much, much longer. But for the average driver, the system does have a memory, but it's not a life sentence. Some companies even offer a feature called accident forgiveness. This is often a loyalty perk for long-term customers with a clean record. It's a one-time get-out-of-jail-free card, where they'll ignore your first at-fault accident and not raise your rates. It's their way of acknowledging your good history and giving you a pass on one mistake. Ultimately, your driving record is the most honest part of your insurance profile. It's not a prediction based on a demographic. It's a history based on your actions. It is your personal driving autobiography, written 1 mile at a time, one decision at a time. It's pure, unvarnished data about the risk you present when you get behind the wheel. It tells the insurance company the story of the driver you have been. But there's another critical piece of the puzzle that's just as personal. It's not just about what you've done in the past. It's about what you're doing right now. Specifically, how much you're doing it. Your annual mileage is one of the simplest, yet most powerful predictors of your future risk. Think of it like this. Every mile you drive is a tiny lottery ticket for an accident. It's a ticket you don't want to win, but the more tickets you hold, the greater your chances. Someone who drives 30,000 miles a year is holding 6 times as many tickets as someone who only drives 5,000. From an insurer's perspective, it's not a question of if that high-mileage driver will have a claim, but when. It's a game of raw exposure. The more you're on the road, the more you're exposed to other drivers, bad weather, road hazards, and simple random chance. So, how do they even know how much you drive? For a long time, it was almost entirely based on the honor system. When you applied for a policy, the agent would ask, "And about how many miles do you drive per year?" You'd give a number, maybe based on your commute, and that would be that. Insurers would then categorize you. Are you a low-mileage driver, typically under 7,500 miles a year? That's great, here's a discount. Are you in the average range, say 10 to 15,000 miles? You'll get a standard rate. Or are you a high-mileage road warrior, clocking in over 15 or 20,000 miles? If so, you're going to see a significant surcharge on your premium. But in a world of data, the honor system is becoming a relic. Insurers now have much more sophisticated ways to verify, or at least estimate, your mileage. When you take your car in for an oil change or a state inspection, the mechanic records the odometer reading. That data often ends up in vehicle history reports like Carfax. An insurer can pull that report and see a clear pattern. Okay, in 2021 the car had 40,000 miles. In 2023 it has 70,000 miles. That's 30,000 miles in 2 years, or 15,000 miles a year. If you told them you only drive 6,000 miles a year to get a discount, you've got a problem. This is called material misrepresentation, and it can be grounds for them to deny a claim or even cancel your policy outright. The odometer doesn't lie. But the real game changer in tracking mileage is technology you voluntarily put in your own car. This is the world of telematics. You've probably seen the commercials. It might be a small device you plug into your car's diagnostic port, or it could be an app on your smartphone that uses GPS and motion sensors. These programs, often marketed under names like Drive Safe and Save or Snapshot, are a direct deal you make with your insurer. The proposition is simple. Let us see exactly how you drive, and we'll reward you for being safe. And mileage is the first and most basic piece of data they collect. Telematics doesn't estimate, it knows. It tracks every single trip down to the 10th of a mile. At the end of your policy period, the insurer has a perfect, undeniable record of your exposure on the road. For low-mileage drivers, this is a golden ticket. Think of a retiree who only drives to the grocery store and the doctor's office, or the new remote worker whose commute is now a 10-second walk to their home office. Before telematics, they might have gotten a small discount for estimating low mileage. Now they can prove it. They can show the insurer with hard data that they represent a tiny fraction of the risk of a typical commuter, and their premium can drop dramatically. But it's not just about how many miles you drive. It's also about the purpose of those miles. Insurers typically break this down into 3 main categories: pleasure, commuting, and business. Pleasure use is exactly what it sounds like. You use your car for errands, visiting friends, and weekend trips. There's no daily repetitive grind. This is considered the lowest risk category because the driving is often done at off-peak hours and isn't a daily necessity. Next up is commuting. This means you use your car to drive to and from a single place of work or school. This is considered higher risk than pleasure use. Why? because commuting miles are some of the most dangerous miles you can drive. You're typically on the road during rush hour, surrounded by thousands of other stressed, distracted drivers all trying to get to the same place at the same time. The driving is repetitive, which can lead to complacency and fatigue. You're also less likely to be able to alter your plans. If a snowstorm hits at 4 p.m., the pleasure driver can stay home. The commuter often has to brave the elements to get back from the office. That's a fundamentally riskier proposition. The highest risk category is business use. This is different from commuting. This applies to people who use their personal vehicle as an integral part of their job. Think of an outside salesperson driving from client to client, a real estate agent showing properties all over town, or a contractor hauling tools and materials to different job sites. These drivers are often on the road all day, racking up enormous mileage, frequently in unfamiliar areas and under time pressure. Their exposure is massive and their rates reflect that. And this category also includes the modern gig economy. If you drive for Uber, Lyft, DoorDash, or Instacart, that is business use. In fact, it's such a specific and high-risk type of business use that a standard personal auto policy won't cover you while you're working. You need a special rideshare endorsement or a full commercial policy. If you get into an accident while your app is on, and you don't have the right coverage, your insurer can deny the claim, leaving you personally on the hook for tens or even hundreds of thousands of dollars. Let's put this all together with the story of two drivers, Sarah and Tom. They're both 40 years old, have perfect driving records, live in the same neighborhood, and drive the exact same model of Toyota Camry. On paper, they look identical, but their car insurance quotes are wildly different. Sarah pays $900 a year. Tom pays $2,000. Why? Sarah is a graphic designer who works from home. Her Camry is for pleasure use. She drives about 4,000 miles a year, mostly for groceries, taking her kids to soccer practice, and visiting family on the weekends. Her exposure is incredibly low. She avoids rush hour, she rarely drives late at night, and her total time on the road is minimal. Tom is a regional sales manager. His Camry is his mobile office. It's classified as business use. He covers a 3-state territory and drives 30,000 miles a year. He's constantly on the highway, navigating unfamiliar cities, and trying to make his next appointment on time. His exposure is astronomical compared to Sarah's. He spends nearly 8 times as many miles on the road, often in higher stress situations. For the insurance company, Tom isn't a bad driver. He's just a far riskier bet. His high premium isn't a punishment. It's the mathematical price of his massive exposure to potential accidents. Your annual mileage and the purpose of your driving paint a detailed picture of your present-day risk. It's a snapshot of your life on the road right now. It answers the questions: how often are you out there? And what are you doing when you are? It's a dynamic factor, changing as your job changes, as you move, or as your life circumstances evolve. But this snapshot is incomplete. It doesn't just matter how much you drive or why you drive. It matters where you park that car at night. And that's where things get surprisingly controversial. Your zip code is one of the most powerful and most debated factors in your entire insurance premium. It can be more influential than your driving record, more significant than the car you drive, and it's something you have very little direct control over. Insurers don't just care about you, the driver. They care immensely about the environment your car lives in. They call this your garaging address, and they have turned it into a science. To understand how deep this goes, let's imagine two identical twins, Mark and David. They are both 35 years old. They both have perfect driving records. No tickets, no accidents. They both drive the exact same car, a 5-year-old Toyota Camry. They even have the same job and the same level of education. By every measure of personal responsibility, they are identical risks. But Mark lives in a quiet, leafy suburb of a major city. David lives just 15 miles away, in a dense, bustling neighborhood right in the heart of downtown. When they shop for insurance, Mark gets a quote for $120 a month. David, his identical twin, gets a quote for $250 a month, more than double, for the exact same coverage on the exact same car for the exact same driver. Why? Because of 15 miles. This isn't an exaggeration. It's a daily reality for millions of Americans. Insurance companies use sophisticated territorial rating systems, breaking down the entire country into thousands of tiny zones, sometimes smaller than a single zip code. They have decades of claims data for every single one of these territories, and they use that data to predict the future. So when they look at David's downtown address, they aren't seeing David, the perfect driver. They see a statistical storm of risk. First, there's density. David's neighborhood has more cars, more intersections, more pedestrians, and more cyclists packed into every square mile. The streets are narrower. The parking is tighter. It's a constant low-speed ballet of bumpers and blind spots. The chances of a minor fender bender, a sideswipe while parallel parking, or a scrape door are exponentially higher than in Mark's spacious suburb, where every home has a two-car garage and wide, empty streets. More cars in a small space simply equals more opportunities for those cars to hit each other. The data proves it year after year. Second, there's crime. This is where your comprehensive coverage comes into play. Insurers track rates of vehicle theft, vandalism, and break-ins with terrifying precision. If David's zip code has a statistically higher rate of stolen cars or smashed windows, the risk of a comprehensive claim skyrockets. It doesn't matter if David parks in a secure, monitored garage every single night. He is still geographically located in a higher risk zone, and his premium will reflect the losses the insurer has paid out for his neighbors. They are pricing the risk of the territory, not just his personal habits. Third, and this is a factor most people never consider, is weather. Certain zip codes are in Hail Alley in the Midwest, where golf ball-sized hail can cause thousands of dollars in damage to every car left outside. Other zip codes are in coastal hurricane zones or low-lying floodplains. The insurer knows the precise meteorological risk of your garaging address and bakes the potential for a total loss weather event right into your premium. Mark's suburb might be on higher ground, just outside the primary flood zone, while David's downtown apartment is in an area known to have issues with drainage during heavy storms. That small difference in elevation can translate to a big difference in cost. And finally, there's the human element, but not in the way you think. It's about repair costs and litigation. A body shop in a high-rent downtown district is going to charge significantly more for labor and parts than a shop in a less expensive suburb. The insurer knows this. They have data on the average repair cost for a specific type of damage in every zip code. Furthermore, some geographic areas are more litigious than others. In certain counties, it's more common for people to hire a lawyer and sue for damages after even a minor accident. This drives up the cost of liability claims, and that cost is passed on to everyone insured in that territory. So for David, the downtown dweller, the deck is stacked against him. Higher traffic density, higher crime rates, potentially higher weather risk, and more expensive repairs and lawsuits. For the insurance company, his zip code is a giant flashing red light of statistical probability. Mark, his identical twin, gets the green light of a low-risk, predictable suburban territory. This is where the practice becomes so controversial. Critics call it zip code discrimination. They argue that these territorial ratings are often a proxy for wealth and race. Historically, lower-income and minority communities are concentrated in denser, urban areas which, for a variety of complex socioeconomic reasons, often have higher crime rates and traffic density. So, are insurers penalizing people for being poor? Are they engaging in a modern data-driven form of redlining, where instead of denying a loan, they charge a prohibitively high premium based on an address? Someone who is a perfect driver, who takes meticulous care of their car, but lives in a bad zip code because that's where they can afford rent, will pay a massive penalty. They are, in effect, subsidizing the losses caused by their neighbors. They are paying for the higher crime rate, the higher accident frequency, and the more litigious culture of their area, factors they have absolutely no individual control over. Insurance companies, of course, have a swift and logical defense. They say it has nothing to do with race or poverty. It has to do with math, actuarial science. They are in the business of pricing risk, and the data is undeniable. More claims and more expensive claims come from certain territories than others. If they didn't charge more for policies in high-risk areas, they would lose money. To stay solvent, they have to match the price to the risk. They argue that it would be unfair to Mark, the suburban driver, to make him pay more to subsidize the high number of claims coming from David's downtown neighborhood. It's a purely economic calculation, they say, not a social judgment. This debate rages on in state legislatures and courtrooms across the country. Some states have put limits on how much a company can use territory as a rating factor, but nowhere has it been eliminated entirely. It remains one of the foundational pillars of insurance pricing. So while you can't easily change your zip code, this is where the specific detail of where you park at night becomes a small lever you can pull. When you get a quote, the insurer will ask if you park your car in a locked garage, a carport, a private driveway, or on the street. Each of those options carries a different level of risk. A car in a locked garage is dramatically less likely to be stolen, vandalized, or hit by a passing vehicle than a car parked on a busy city street. If you have access to a garage, telling your insurer can shave a meaningful percentage off your premium, especially if you live in a high-risk zip code. It's you signaling to them that even within a risky environment, you are taking the maximum possible steps to mitigate that risk. Your address tells a story of collective risk, a story written by the actions of thousands of people around you. It's a story of statistics, probabilities, and cold, hard data. But the insurance algorithm isn't done building its profile of you. It has looked at your car, it has analyzed your driving habits, it has mapped out the risks of your neighborhood. Now it's about to get much more personal. It's going to look at something that seems to have absolutely nothing to do with your ability to operate a 2-ton machine, yet it can change your premium more than almost anything else we've discussed. It's going to look at your wallet, your credit score. To be more specific, your credit-based insurance score. And yes, that's a real thing. In nearly every state across America, the number that tells lenders how likely you are to pay back a loan is also used to tell insurers how likely you are to file a claim. To many people, this sounds insane. It sounds unfair. What on earth does my Visa bill have to do with my ability to merge onto a highway? The answer, according to decades of insurance industry data, is a lot. Let's unpack this because it's one of the most controversial, least understood, and most powerful factors in determining your car insurance rate. Insurance companies are in the business of predicting the future. Their entire model is built on guessing how likely you are to cost them money. For years, they've collected massive amounts of data, and what they found was a startlingly strong correlation. People with lower credit scores on average file more claims. They file more frequent claims, and their claims tend to be more expensive. Now, it's crucial to understand the industry's argument here. They aren't saying that having a low credit score makes you a bad driver. They are saying that the behaviors that lead to a lower credit score, like missing payments or carrying high debt, are statistically linked to other behaviors that lead to more insurance claims. Their argument is that a person who is responsible with their finances is, on average, more likely to be a responsible driver, more likely to maintain their vehicle, and more likely to be cautious on the road. It's a correlation of responsibility. A person who manages their financial risk well, they argue, also tends to manage their driving risk well. As you can imagine, this is a hornet's nest of controversy. Critics argue that using credit scores is fundamentally discriminatory, penalizes people for being poor, not for being bad drivers. Someone could have a low score due to a medical emergency, a job loss, student loan debt, or a divorce, life events that have absolutely nothing to do with their driving habits. A single mother working 2 jobs to pay off hospital bills might be a far safer driver than a wealthy CEO with a perfect credit score who texts while driving his new Mercedes. Because of this, a few states have taken action. California, Hawaii, and Massachusetts have banned the use of credit scores in setting auto insurance rates. In a few other states like Maryland, Oregon, and Utah, there are restrictions on how it can be used. But for the vast majority of the country, your credit history is fair game, and it can swing your premium by hundreds or even thousands of dollars a year. So, how does it actually work? Insurers don't just pull your FICO score and call it a day. They use a proprietary model to calculate a credit-based insurance score. While the exact formulas are a trade secret, they are built on the same data as your regular credit score. Let's break down the key components. First and most important is your payment history. This is about 40% of your insurance score. Do you pay your bills on time every time? A long history of on-time payments signals stability and responsibility to an insurer. Late payments, delinquencies, and collections are huge red flags. Second is your outstanding debt, also known as your credit utilization. This makes up about 30% of the score. Are your credit cards maxed out? Or do you keep your balances low relative to your credit limit? High balances can suggest to an insurer that an individual is under financial stress, which they believe correlates with a higher likelihood of filing a claim, perhaps even a fraudulent one. Third is the length of your credit history, which accounts for about 15%. A longer history of responsibly managing credit is a positive sign. It shows a track record. This is one reason why it can be harder for young people to get the best rates. They simply haven't had enough time to build a long positive credit file. Fourth is the pursuit of new credit. This is about 10% of the score. Have you applied for a bunch of new credit cards or loans in the last year? A flurry of applications can signal financial distress to an insurer, making you look like a bigger risk. And finally, your credit mix, the last 5%. This looks at the different types of credit you have, things like credit cards, a mortgage, an auto loan, and student loans. Having a healthy mix of different kinds of credit and managing them well is seen as a positive. Now, what's not included is just as important. By law, your credit-based insurance score cannot use any personal information. It can't look at your race, color, religion, national origin, gender, or marital status. It also can't use your income or your specific address. It is purely based on the financial data in your credit report. The impact of this score is staggering. A study by the Zebra found that moving from very poor credit to exceptional credit can cut your car insurance premium by more than half, saving an average of over $1,700 a year. That's more of an impact than having an at-fault accident on your record. It's more of an impact than going from age 25 to age 55. Your ability to manage debt can literally be more important to your insurer than your ability to drive. So what can you do about it? This isn't just some random number you have no control over. The single most important thing you can do is get a copy of your credit report and check it for errors. You are legally entitled to a free report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. You can get them at annualcreditreport.com. A simple error, like a debt that isn't yours or a late payment that was actually on time, could be costing you a fortune. Dispute it immediately. Beyond that, the path to a better insurance score is the same as the path to better financial health. Pay every single bill on time, even if it's just the minimum payment. Set up automatic payments so you never forget. Keep your credit card balances low. A good rule of thumb is to use less than 30% of your available credit. Don't close old credit card accounts, as that can shorten your credit history. And don't apply for new credit you don't actually need. There's also a little-known protection in some states for extraordinary life events. If your credit was negatively impacted by a catastrophic event, like a divorce, the death of a spouse, a serious illness, temporary job loss, or identity theft, you may be able to ask your insurer to disregard that negative history when calculating your rate. You'll need to provide documentation, but it could provide significant relief. The use of credit scores is a brutal, data-driven reality of the modern insurance market. It's a system that judges your future on the road by looking at your past in the bank. It turns your financial report card into a key determinant of your driving risk profile. We've now covered where you live, who you are, what you drive, and how you manage your money. We've peeled back nearly every layer of the onion, but there is one final piece of the puzzle. It's the part that puts all the power back in your hands. It doesn't matter if you have a bad driving record, a low credit score, or live in a high-cost state. This last factor is your ultimate trump card, the one lever you can pull that can override almost everything else we've talked about. It's the art and science of shopping for insurance itself. And in our final part, we will show you how to become a master at it. This isn't just about saving a few bucks. This is about fundamentally changing your relationship with insurance. For most people, an insurance bill is something that just happens to them. It arrives, they pay it, they complain about it, and the cycle repeats. But by mastering the art of shopping, you move from being a passive recipient of a price to an active participant in determining it. You turn the tables. So, where do most people go wrong? The first mistake is timing. They wait until their renewal notice arrives, see a price hike, and then frantically call 1 or 2 other places in a panic. That's playing defense. We're going to play offense. You should be shopping for car insurance not just at renewal, but anytime a key data point in your life changes. Get married? Your risk profile just changed dramatically in the eyes of an insurer. Shop for insurance. Move to a new zip code, even just a few miles away? That's a massive variable. Shop for insurance. Pay off your credit card debt and see your credit score jump 50 points? That's a huge win. Capitalize on it and shop for insurance. A speeding ticket from 3 or 5 years ago finally falls off your record. The system just wiped a major red flag from your file. It's time to shop. Buying a new car, adding a teen driver, even changing jobs if it drastically shortens your commute. These are all trigger events. Think of them as alarms on your phone telling you, there's money on the table. Go get it. The second mistake is not understanding who you're getting quotes from. You have 3 primary avenues, and using them in combination is the key. First, you have what are called captive agents. Think of your local State Farm, Allstate, or Farmers agent. They are captive because they work for and sell products for only one company. The upside is they often have deep knowledge of their company's specific discounts and policies. The downside is obvious. Their toolbox only contains one brand of hammer. If that brand isn't the right fit or price for you, they can't offer you anything else. Second, you have the direct-to-consumer companies. These are the ones you hear advertising constantly, think Geico and Progressive. You go directly to their website or call their 800 number, cutting out the middleman. This can sometimes lead to lower overhead and better prices, but it puts all the work on you. You have to navigate their systems, input all your own data, and be your own advocate. But the third option, the one that is criminally underutilized, is the independent agent or broker. These are the secret weapon for smart shoppers. An independent agent doesn't work for one insurance company. They work for you. They represent multiple carriers, sometimes dozens of them. You give them your information once, and they go out and shop the market on your behalf, bringing back a selection of quotes from different companies. They are, in effect, your free personal insurance shopper. They know the market, they know which companies are competitive for your specific profile, and they can help you compare the fine print. Not using an independent agent is like trying to find the best flight by only checking the American Airlines website. You're ignoring a massive part of the market. So the master strategy is to use a multi-pronged attack. 1. Get a quote from an independent agent to see what a wide swath of the market can offer. 2. Get your own direct quotes from one or two of the big direct-to-consumer players that the independent agent might not represent. And 3. If you have a current agent you like, let your captive agent give you their best renewal offer. Now you have a true comprehensive view of your options. You've created a competitive marketplace where your business is the prize. This brings us to the third, and perhaps most critical mistake: comparing apples to oranges. You get 3 quotes back. One is for $600, one is for $750, and one is for $900. The $600 one is the best deal, right? Wrong. Not until you've looked at the coverage. A cheap policy is often just that, cheap. It's a house of cards that will collapse the moment you actually need it. When you compare quotes, you must demand that the core coverage levels are identical. Look at the liability limits. That's the coverage that pays for injuries and damages you cause to others. One quote might have the state minimum liability limits, which are a financial trap designed to leave you exposed to personal lawsuits. Another might have robust limits of $250,000 and $500,000. These are not the same product. Look at your uninsured and underinsured motorist coverage. This is what protects you and your family if you're hit by someone with no insurance or not enough insurance. Don't let one company quote you the bare minimum, while another quotes you proper protection. And look at your deductibles for collision and comprehensive. A quote with a $2,000 deductible will always be cheaper than one with a $500 deductible. But are you prepared to pay that much out of pocket after an accident? You must standardize these numbers across every single quote. Tell each agent and each website, I want a quote for these exact liability limits, these exact uninsured motorist limits, and this exact deductible. Only then, when the coverage is identical, can you truly compare the bottom line price and see who is actually offering you the better deal. Now, after all this work, understanding the timing, using all the avenues, and comparing apples to apples, you might wonder why it's so necessary. Why can't you just stick with the company you've been with for 10 years? Surely they're rewarding your loyalty. And this leads us to the final, hidden truth of the insurance world. It's a concept called the loyalty penalty, or price optimization. It sounds counterintuitive, but insurance companies have mountains of data that show the longer a customer stays with them, the less likely they are to shop around. They become comfortable. They set up autopay and forget about it. And some companies, knowing this, will slowly, incrementally, raise your rates year after year by just a little bit more than they should. They are betting on your inertia. They are charging you a tax for your loyalty, optimizing their price based not just on your risk, but on your unlikeliness to leave. The reward for being a loyal, hassle-free customer for a decade can sometimes be a policy that costs hundreds of dollars more than what a brand new customer would pay for the exact same coverage. It is the single most compelling reason to shop your insurance regularly. The simple act of getting competitive quotes forces your current carrier to see you not as a captive, loyal cash cow, but as a savvy consumer who needs to be won over again. Sometimes, just showing them a competitor's quote is enough to magically make your own renewal price drop. So, what is the takeaway from this entire series? After exploring every factor from your zip code to your driving record, from your credit score to the color of your car, it all comes down to this. You are in control. You are not a victim of the algorithm. You are a participant in the system. Here is your plan. Put a reminder in your calendar for 1 month before your policy is set to renew every single year. Title it Annual Insurance Review. When that reminder goes off, you will do 3 things. You'll pull up your current policy to remind yourself of your coverage levels. You'll call one independent agent and ask them to shop the market for you. And you'll go online and get direct quotes from 2 major carriers. The entire process will take you less than 90 minutes. For that hour and a half of your time, you could save yourself $500, $700, even $1,000 or more. That's not just money. That's a vacation. That's a contribution to your retirement fund. That's peace of mind. We've demystified the black box. We've shown you the levers they pull, and more importantly, the levers you can pull. Insurance is complex, yes, but it is not unknowable. It is a product and you are the consumer. And an educated consumer is the most powerful force in any market. You now have that education. You have the strategy. You are no longer just a driver. You are the CEO of your own financial well-being, and you now have the tools to make the best possible deal. Go use them.